welcome to On the Investor's Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to learn about what investors are focusing on right now and how that fits in with your portfolio construction and asset allocation. Now, in this episode, we have a very special guest, Gabriela Santos, who's our Chief Market Strategist for the Americas, who's based in New York, but she's in Asia this week, joining us at the Global Research Summit. And more importantly, a great friend and also a very close working partner for insights on what's happening in the US. So in this episode, I want to take this opportunity to really tap Gabby's experience on what US investors are thinking right now. So Gabby, welcome back to Asia. I think last time you were here was a year ago when we talked about the guide to investing in Asia. And so, with our US team, the America's Market Insights team, hosted around 1,200 meetings so far year to date with our clients in the US, in Canada, and broad Latin America so far this year. What's been their top questions?
Sure, Tai, and thank you so much for having me on the podcast again. It's great to visit. So I would really put it into three buckets. I think when it comes to macroeconomic related questions, it's changed quite a lot. Last year, it was all about hard landing, soft landing. The year before that, it was all about inflation. When is it going to come down? I think this year, there's a bit more comfort that there is a soft landing on track and that inflation is slowly making its way back to the Fed's target. So really the questions we've been getting are a little bit less short-term in nature than they used to be. We do still get the odd question around the American consumer and really how long they can keep the economy on the soft landing path. It's truly amazing. Consumption has been a lot stronger than we expected, growing about 3% this year. It seems as long as Americans have a job, their wages are now growing a little bit above inflation, people are more than willing and able to spend. So that I would put in the macro bucket. The second one, in terms of market questions, it's all about artificial intelligence. Is it overhyped? Is it for real? Are there any other companies besides just the Magnificent Seven that are ways to invest in this theme? So a lot of questions, and this year especially, a lot more questions beyond the Mag 7. There's been a lot of interest in how much electricity and energy processing these large language models is going to take. And so a lot of investors interested in utility companies, for example, which are doing just as well as tech companies are this year. And then lastly, the third bucket related to policy, I think U.S. investors, of course, are very heavily focused on the U.S. election from a personal standpoint of what it means for their lives and their financial planning. In terms of what it means for the markets, we get the most questions around the deficit, the growth of the debt, and what this is going to mean for interest rates, but especially long-term rates. Is the U.S. eventually going to have to pay some kind of price for running these very high deficits and this growing debt pile, which is, of course, only set to get worse after the U.S. election?
So it sounds like that the US investors are not that different from the investors in Asia across the whole Pacific, despite the distance. Elections, AI, I think the scenario of a soft landing or hard landing, I think that's very similar to what we've been getting. And 2 weeks ago, we've got our boss, Dr. David Kelly, sharing his thoughts on the election. So for those of you who want to review that discussion, it's also in our last episode of the podcast. So with all that in mind, Gabby, what's been your recommendation to these investors and clients in terms of both tapping the potential opportunities as well as managing some of the risks going forward?
So I think it's been interesting because there's a glass half full and glass half empty way of looking at how strong performance has been this year and was last year. And here especially for US equities and US fixed income. The glass half full is rightfully so. There is certainly a soft landing in place and a lot of technological innovation happening, and the Fed is cutting interest rates. But the glass half empty way to think about it is valuations are expensive again. For the US equity market, back to nearly 22 times, which is quite elevated versus long-term average. And for fixed income, a lot of yields already moved lower in anticipation, of course, of inflation coming down and the Fed starting its rate cutting cycle. So we've been speaking a lot more about being a lot more nuanced about expressing positive views on the economy and on innovation. For example, within the equity market, we continue emphasizing the risk that this high concentration in just a handful of stocks poses. The top 10 companies still representing about a third of the whole US equity landscape. We don't think it's a bubble. These are truly companies that are innovating in the AI space and already monetizing it. But that's where valuations are a bit more extended. There's a lot of positioning already. And so we've been talking about other parts of the market where finally there's earnings coming through after a tough couple of years, and other ways to express positive views. So for example, utilities, as we mentioned, is one way to express really the electrification of the economy. Healthcare, where there's so much innovation happening. Industrials, also related to electrification and the renewal of manufacturing. So there's a lot to do. This is just US equities, though. We also try to emphasize other opportunities in global equity markets. Within fixed income, we talk a lot about how going forward it's just going to be about the income instead of expecting big capital appreciation. In terms of duration, since we don't expect intermediate long-term yields to move lower, we've been thinking about a sweet spot being more short duration, which is still not cash, but no need to extend duration too much. And we also talk about corporate credit as a way to improve the income given the positive outlook. So certainly a lot of investment opportunities, but the main risk actually underlying that is really valuations and the concentrated nature of recent performance. Lastly, Tai, I think investors were very used to just diversifying for recession risk. And even though we don't think a hard landing is due, we would still maintain certain diversification to that and a focus on quality companies. But now we keep emphasizing the need to also diversify for inflation and inflation uncertainty. Inflation seems to be normalizing now, but it may pop up again. And this is where I think alternatives can be very, very important, especially real assets, things like infrastructure and transportation, which can provide income, but also very low or negative correlation to other parts of the portfolio.
No, I think absolutely. So I think in the last few years, we've been emphasizing again to our Asian audience and clients the role of alternatives. It's a very much a catch-all category because it does have a broad range of assets within the alternative space, where some of them is, as you mentioned, provide some inflation protections because these infrastructure may have an inflation component explicitly written into the service contract, and at the same time there are other aspects of alternatives like private equities probably will have a bit of a lower correlation with the public market. So I think while a lot of Asian investors are very familiar with equities and fixed income in the public markets, we're certainly gaining more traction both with institutional clients and also private wealth clients when it comes to alternatives.
And that's true in the US as well, Tai. It used to be just institutions, right, that invested in alternatives, and now you're seeing this greater ease for private wealth to invest as well. And there's a whole education component to it.
So thanks. I mean, it's great to understand what you're talking to clients in the US and the broader Americas right now. And let's come back to Asia. I mean, again, a year ago when you visited, we spent a lot of time talking about the Guide to Investing in Asia, where we revamped the publication really in the interest of a lot of our international clients when it comes to investing in our part of the world. And also we get a lot of questions from Asian clients on how do international investors think about Asian markets and broader Asian assets. For example, we've seen a big increase in interest in Japanese equities over the past couple of years. That was a hot topic when I visited New York back in May. Taiwan's clearly benefited from the AI boom. Again, that fits in with one thing you've mentioned earlier when it comes to artificial intelligence. China went through some very large swings in the market in the last couple of weeks because of the prospects of more stimulus coming from the government and the central bank. And as I mentioned earlier, our team in the US and also in Asia worked together to put together the guide to investing in Asia. I think that's due in the first week of November. So what's the level of interest by US investors and America's investors in Asia, both by market and also by segment or industries?
Thank you, Tai, and thank you so much for your help and the team's help on really understanding all of these different economies and markets. We were used to a lot of interest in Asia from our LATAM clients who have, especially in certain parts of South America, like Chile, they have dedicated exposure to Chinese countries and markets. But recently, it's been a lot more interest from the US client base, and here especially our institutional clients, such as pensions and endowments, that are very keen to understand all of the different dynamics taking place in Asia. In terms of types of assets, I would say primarily it's really equities, and really thought of as a growth area with higher potential return, versus fixed income where we don't quite at the moment see that much interest. Recently, we've also been seeing a bit more interest in things like private equity, venture capital, when it comes to especially India has becoming a more interesting topic in that private market side. I think over the last few years, there's been a change in the discussions around investing in Asia. In the beginning, it was all about China. First, a lot of investors were growing their dedicated exposure to Chinese equities. And then given the tough performance over the last 3 years or so, it was about mitigating risk in portfolios towards Chinese assets. And here there was a whole rethink of how exactly to invest in China. Some investors preferred to just roll it up into a broader emerging market allocation instead of having a dedicated sleeve. Some other investors kept a dedicated sleeve, but really focused a lot more on active management, alpha, really honing in on specific sectors that are still appealing, like domestic demand, as well as business innovation. But more recently, we've been speaking to a lot of US clients about understanding the rest of Asia. And here, I think on the equity side, first off, a lot of investors are rethinking building a strategic allocation to Japan, which is a huge change. Before, it used to be thought of a bit more of a tactical investment if US clients had any. And now there's a lot of studying and thinking about the corporate governance changes taking place. How real is it? How much more room is there to run? What's the best way to invest in the Japanese equity story? I think there was a bit of a pause there in early August with the unwind of the carry trade and some of the hiccups there, but I think that's just a pause. A lot of investors are really thinking about this as a long-term allocation. A lot of interest as well in Taiwan, and part of this idea of amplifying and broadening how to invest in the artificial intelligence theme. And then lastly, India. I don't think a lot of US investors kept up with how much India has grown in representation in the EM index. And really a lot of investors are trying to understand the different dynamics there. They're a bit put off by the valuations, which are just very expensive no matter where you look. But I do think if we do see any kind of correction or a little bit of a reprieve there, that's an allocation that US clients are looking to build over time.
That's great. I think the key here is that I think a lot of US and America's investors are still looking very closely at Asia. I think, again, that's not that different from my conversation with our clients in Asia, where clearly China's gone through some difficult times. So in the last few weeks, we've been getting lots of questions on whether the stimulus and the economic policy can genuinely change things around. And at the same time, the corporate governance story you mentioned about Japan, it's something that we've been advocating a lot, both at the Market Insights team, but also from the broader investment management team. on the long-term development of Japan as an investment destination. I think on this trip we talked a lot about the politics in the US and how supply chains are shifting, and I think the Indian growth story, the broader EM Asia growth story. I think again that fits in very nicely with all the changing politics and the shifts in the global supply chain. So Gabby, thanks for joining us today, and thank you all for tuning in. So if you have any questions, feel free to reach out to your JP Morgan Asset Management client advisors, and also please subscribe and share with your friends and colleagues if you find this useful. I'm Tai Hui. I'll see you next time to discuss what's on investors' minds.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.